Welcome, options traders. I had some traders the other night asking if there is a formula you can use to estimate an options price if you're expecting a large gap, let's say on the opening bell. And the answer is yes. Why would a trader want to know this? Well, let's say you're holding an option, closed at $3 last night, but now it looks like the stock is going to gap open $5 on the opening bell. And the trader doesn't want to place a market order, but at the same time is saying, what might be a good estimate for this options price? Most traders are going to say, well, let's just multiply that change in the stock's price by delta. And unfortunately, that's going to make you severely underestimate that options price. So let me show you a nice little formula that you can use for those moments. Of course, it works whether we're looking at up or down. I'm just going to look at it to the bullish side. But if you happen to get a gap down, it's the same idea, just in reverse. So the first thing to understand is the Greeks. Remember that delta shows how sensitive an options price is to changes in the stock's price. And gamma shows the sensitivity of your delta. So if you're not too up on these terms, I do have other videos in here that will explain them in detail. But for this video, the thing that you need to understand is that delta and gamma change as the stock price changes. That's the kicker. This is why you can't just multiply a $5 change in the stock's price by delta and expect to have an accurate answer. That delta has changed multiple times throughout that 5-point run. And if you're not accounting for that, you're going to be very off in your estimate. So remember that your Greeks only apply for small changes. So if we're talking about delta, we're talking about a small change in the stock's price. Yeah, most traders will say it's for $1, which is technically too big, but it's not that big to where you're going to be off by a lot. Or maybe theta for time decay. We usually assume it's for a 1 day's passage of time, when technically that's too long. But it will still give you reasonably good estimates. But that's no longer true when we're talking about large gaps in the stock's price. So let's take a look at how these work. Let's say we've got a stock at 100 and our $100 call is trading for 3. We look at our broker's platform. It tells us the delta is 0.5 and let's say the gamma is 0.10. What does this mean? It means if the stock price rises by $1 full right now, and this is an important assumption, we're talking about an instantaneous change of $1, not in a week or in a month or even in an hour from now. Because technically, if we were, we would have to account for time decay. So whenever we're looking at delta, it always assumes an instantaneous change in that stock's price. So if that's true, how much are we going to increase our options price by? Well, we're certainly not going to pick up a full dollar like we would if we were owning the shares. Instead, we're going to pick up delta right here. Delta shows you the percentage that you're going to pick up from that change in the stock's price. So if we're going to assume that the stock price made a $1 change, we're picking up 50% of that. So my option's probably going to move from about $3 to $3.50. But now what about the next dollar change? What if the stock goes from 101 to 102? My delta is not going to stay at 50. Remember, your Greeks change over time. And they change as everything else changes, as time changes, as the stock price changes, as volatility changes. So gamma is going to show you by how much you're going to increase your delta. So gamma here is showing 0.10. It means we're going to pick up 10 deltas. So I'm no longer going to have a delta of a half. It's going to be 0.6. So here we are still looking at our broker's platform. Our stock is now at 101. Our $100 call trading for 350. And our platform shows our new delta at 0.6. It's increased. Our gammas will also change. Let's say that it's dropped to 0.08. Depending on where you are on that gamma curve, you're either going to rise or fall. Once the option is passed at the money, your gamma is generally going to decline. But regardless of what the numbers are, here's the way that it works. Again, we're assuming an instantaneous change in that stock's price from 101 to 102. How much am I going to pick up? Well, I'm not going to pick up 50% like I did last time. That was my old delta. I'm going to pick up 60% of that dollar's change. So if I increase my options price by 60 cents, that's going to move from about $3.50 to $4.10. And that's going to give me a reasonably good estimate of what that option will be trading for. So remember, this formula works very well when we're talking about moderate changes in the stock's price. It does not apply when we're looking at large gaps. So if the stock makes a large move, delta and gamma won't give accurate measures, at least by themselves. And again, that's because delta has changed several times over. So if we have our stock at $100 call at 3, and our delta at 50, let's say that maybe during pre-market the stock looks like it's going to gap up $5. Well, I can't just take my delta of a half here and say I'm going to pick up half of that, or $2.50, and therefore my option's going to trade for $5.50. That's going to severely underestimate that option's price. So instead, what you need to do is to look at a formula. Now there's a little bit of math here, it's not that hard, but let me just show you how it works. I'm just going to call the change in the stock price X, just to make it easy. So in my example, if the stock price increased $5, X is 5. So the formula is a two-part process. The first one is you're going to take X, this change in the stock price, times your delta. And that's going to give you some number. Now again, this part of the formula works well if we're only talking about a small change in the stock's price. But because we're now talking about a large gap, we need to add a little correction factor. So we need to look at part 2 of the formula. And here's the way it works. We're going to take our gamma and divide it by 2, and we're going to multiply it by X squared, or that change in the stock's price squared. So again, if we're assuming that the stock price increases $5, 5 squared is 25, take your gamma divided by 2, multiply those together. And it's these two pieces right here that we have to add to that option's price to get a better estimate. So I know it looks confusing, but it's actually quite easy. Let's take a look at an example. Again, we'll use our stock at $100 call at 3, delta of a half, gamma of 0.10. Let's say that the stock rises, let's make it $4 this time. Part 1 of the formula says take that $4 change times your delta. So our delta is a half, $4 is the change in the stock price, that gives us $2. So I know at a minimum this option is going to increase by 2. But now let's add this little correction factor here. My gamma is 0.10. 0.10 divided by 2 is going to give me 0.05. The change in the stock's price was 4, so 4 squared is 16. So if I take 16 times 0.05, that gives me 0.8. So now it's these two pieces right here that I have to add. My options price is going to increase by about $2.80. So I would expect that it's going to rise from 3 to about $5.80. So let's go over to the CBOS pricing model and see how accurate this formula is. So here we are in a pricing model, and I'm going to choose the stock price at 100, strike at 100, 30 days to expiration. Down here I'm going to put the interest rate at 2, and I've chosen this odd sounding 25.53% volatility because that's the number necessary to give me a $3 call price, which is what I was assuming. But now let's say that we're expecting the stock price to gap $5 on the opening bell. I have a delta of 0.52, gamma of 0.0544. Most novice traders would say, well, let's take this $5 change in the stock's price times your delta of 0.52. And that's going to give you $2.60. So they're going to tack that onto this $3 option price and say, well, I would expect it to be trading for $5.60. But watch what happens. It's actually $6.25. You're off by a long shot because you didn't account for these changing deltas. I mean, take a look right here. Your deltas are up to 77. They're a long ways off from 0.52. So let's go back and apply our formula and see how much better of an estimate we can come up with. So remember, part 1 is assuming we're talking about a $5 gap in the stock's price times my delta of 0.52. And as I showed, that's going to be $2.60. That's the minimum that you're going to tack on. But now let's add this correction factor. We take 0.0544, that's the gamma, divided by 2, which is going to give me 0.0272, somewhere in there. And we're going to multiply it by the change in the stock price squared. We're assuming the stock price increases $5, 5 squared is 25. So I'm going to take this 0.0544 divided by 2 times 25. And that's going to give me about 68 cents. So now let's take the 260 that we came up with from part 1 plus 68 cents, and that gives me $3.28. So I would expect that this options price will increase by $3.28. So let's go back over here and make this 105, choose calculate, and 626, pretty close. So what else are going to cause errors? Well, the larger the gamma and the larger the gaps in that stock's price, the larger the errors become. But still, remember that better decisions are made with better estimates. So I hope this allows you to use this in those cases where you can make better estimates. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.